Welcome, everybody. Thank you so much for joining me here. I know it's a busy holiday week, but I appreciate you joining me. It is Tuesday, right? 2 days for the big Turkey Day coming up. But what's gone on in the market over the last, let's say, 2 weeks or so, and we'll take a look at a lot of charts today. It's something it's pretty rare. We are seeing some extreme levels of indicators that have been around for decades that I've followed for over 20 years, hitting levels that are rarely seen. And when they are seen, it creates a really great long-term opportunity, even short-term opportunity. So we're going to go through a lot of that today because I think it's really, really important that you know where you stand with the market, why you feel the way you feel when stocks are pulling back. And the most important thing we're going to talk about is the hidden infrastructure is powering the AI revolution. We all know about AI. Love it, hate it. It's here. It's not going anywhere. It's only growing exponentially. But maybe some of the stocks that you identify with AI, let's say the Magnificent Seven, Alphabet, former Google, up huge the last 2 days. NVIDIA down, but Google up, closing in a $4 trillion valuation. Is that going to be a double from here? Yeah, I'm sure it could hit $8 trillion at some point. I don't know. People thought it was crazy when Apple hit $1 trillion and made it to 4. So yeah, it could go to 8 trillion. The thing is, there's a lot of other companies, the picks and shovels, if you will, that are empowering all these companies to create what they're creating in the early stages of this huge mega trend that is artificial intelligence. Those are the companies that we have exposure to already in some of the portfolios in McCall Letter, but 5 new ones I'm adding today. Excuse me. And I'm going to share one for free at the end of the presentation. So let's jump into it here. Let's just get right into the presentation and get moving. Again, what we're going to talk about here today, current situation, panic ensues. And then, of course, revealing the digital infrastructure portfolio, because there's nothing greater than melding innovation technology with infrastructure, two trends that I love, and putting them together. And it was tough to really whittle this down to 5 stocks, but I had to pick 5 stocks that covered all angles of what is being built here with this mega trend. So for those who don't know who I am, a lot of new people jumping on here today. My name is Matt McCall. I'm the founder and head of investments at Next Wave Research. It's one of my newer companies. I've created and sold over 5 companies, all different industries, newsletter business, I had a broker dealer. I had a registered investment advisory firm, managed money for over 17 years. I had a crowdfunding company, sold all the above. I owned a Pilates company, sold that. So a little bit of everything, just kind of keep my brain moving. But this is my venture that's always been kind of my heart and soul, doing research on individual stocks and building portfolios around mega trends and allowing access to the retail client, the average investor. And that's what we're achieving here at Next Wave Research. A lot of people like to brag. I say this because a lot of people don't know who I am, just to prove that I have a track record. Over the last 20 years, I've recommended over 60 stocks that have gone up at least 1,000%. That's 11x. Over 1,500 times I've appeared on Fox News, Fox Business, CNN, CNBC, you name it. I was one of the few people that when they put on their resume, Fox Business / Fox host, Fox News, paid contributor. People I see on LinkedIn all the time. You're not a paid contributor. I know you. I was one of the very, very few that actually paid to come on every single day. So not that that means anything, but they thought enough of me to pay me to come on there. And now, again, as I mentioned, dedicating my life to educating and offering the highest level of research to the masses. That's what we're here for. So here's the current situation, folks. And real quick, before I go any further, if you have comments, questions, please put them in chat on the right. I'll be looking at that throughout. So please put them in there and I'll answer questions as we go. It gives me a break of talking to read the questions as well. So current situation. Let's just say stocks are in the midst of a breather or a reset. And I was hesitant to even use that. And I worked on this over the weekend. So stocks have bounced the first 2 days of this holiday shortened week. Just logging in right now as the market's closing today, the S&P is now down less than 2% from an all-time high. Even the S&P equal weight ETF, which we're going to talk about a little bit later, which is not as focused on the big names, down less than 2% from an all-time closing high. So we are seeing stocks bounce back dramatically. But I got to be honest with you. I'm in the same camp with many people out there. It sure as heck doesn't feel like we're in the midst of a situation where the market's only down less than 2%. So the drawbacks, as I mentioned, for the market have been mild. Even when the S&P was down about 4.5% last week, for individual stocks, it was much more, and it was sudden and sharp. And I found this great statistic. For the S&P 500, 82% of the stocks, which is about 412 of the stocks, of the 500 stocks, at one point here in the last week, were down at least 20%. That's a bear market. Yet the S&P was only down at the time 4.4%. This was late last week. So if it feels like your portfolio is underperforming and you're don't have exposure to the 88 stocks that are not in bear market, then yeah, you're probably underperforming the market. If you're not overweight the Mag 7, the big trillion-dollar companies, I guarantee you're probably, unless you're internationally invested, because international stocks have done great. We have a lot in our portfolio. Unless you're internationally invested, you're probably lagging the market. It's just the numbers are going to prove it. So what I want to do is get into a bunch of charts, because for me, I'm a visual learner, and I think I'll talk you through this, but we have a lot of charts to go through. And this was last week. This is the CNN Fear and Greed Index. They take, I think, somewhere between 8 and 11 or so different indicators and look at them based on fear and greed. This is 6. I've never seen it this low, and maybe it has gotten this low. I've never seen it this low. This is extreme fear. This is between 0 and 100. This is at 6. I've seen it in the 80s and 90s, extreme greed. I've seen it, fear, neutral greed. I've seen it in the teens. But 6 is unheard of, folks. That's the extreme fear that is being measured by multiple indicators out there. Multiple. When I checked earlier today, it's up to 13. Still extreme fear, but up to 13. This is an interesting one. This is the Goldman Sachs, what they call the U.S. Panic Index. And it's just recently reached an extreme. It takes, again, a bunch of proprietary numbers and looks at the panic within investors, similar to the CNN Fear and Greed, but a little bit more proprietary by Goldman Sachs. And you take a look at this. This is just the last couple of years, but it's hitting levels that it very rarely sees. This oscillates between 0 and 10. As you can see, where we're at right now, closing in on that 10 level. I mean, this is, again, just showing you the volatility panic we're seeing out there right now. How about the University of Michigan Consumer Confidence? Comes out every month. We all know about that, right? Just hit the lowest level ever. This is going back to 79, basically my lifespan. Lowest level ever. And I think back, I was 3 years old in 79? Think back, I don't remember everything as a kid, but shit, there was a lot worse times that you would be a lot more concerned as confidence, as a U.S. citizen. University of Michigan Consumer Confidence, the lowest level ever. But you look at the other times it was low. June 2022, August 2011, November 2008, right before market rallies. Every single time right before market rallies. This one is very interesting. This is the VIX, the CBOE Volatility Index. And this is last Thursday. I don't know if you remember last Thursday, the market opened up. Like, man, I was in Pennsylvania visiting family. This looks great. I went out for a run out in the country, came back. What the hell happened? Market did the opposite of this. But the VIX rallied 45% intraday. And when I say intraday, I mean in a few hours. Excuse the horrible drawing I have there. But a few hours. That's amazing to me. 45% move in the VIX. That shows the fear went through the roof in the VIX. Very rare to see something like that. Here's one more. This is the SPXU. This is a ticker symbol, the SPXU. The SPXU is the inverse of the S&P 500. So what this chart shows is the amount of volume, the amount of people buying into the inverse. So basically shorting the market, spiked. And look at the few other times it spiked. And of course, put together a really nice chart here. You can see the other times that it had over $1 billion in daily volume transacted, which it just did. You look 1, 2, 3, 4. I don't care 1 week later, 2 weeks later. I don't really care 1 month later, but I'm going to look at it. Because you look at 3 weeks later and 1 month later. Look at this. The average 3 weeks later, gain of 9.4%. That's what the market averages on a year in 3 weeks. Go out one more week, 1 month, 11%, 100% of the time when this happens. That shows that the retail investors and the people that are chasing this and using these very leverage and inverse products, most of the time are horrible at timing the market. And we're seeing that right here. So again, this tells me I want to be buying, which is one of the many reasons I put together this portfolio and releasing it today, releasing it right at the end of this live that we're doing right now. So this was last week, but just move this over a little bit. But this is pretty interesting. This is from Ryan Dietrich over at Carson. It shows the S&P returns in November going back to 1950, so almost 75 years. See, November normally starts out decent, but it has this pullback and then bottoms around the 20th. Well, when do you think we bottomed? Right around the 20th, and we've been taking off since then. So we've been rallying since that time. Do we follow this? I don't know, but maybe there's something with that time frame. This is more fun throwing it out there. I never buy the market based off that, but throwing it out there anyway. But again, folks, I'm going to keep flying along here. But if you have any comments, questions, please put them in the chat because I will take them as we're doing this. So the next question to me is, and this chart's from a couple of days ago, but what am I missing? What am I not seeing? This is from November 22nd over the weekend. Because at this point you had the S&P still up about 13.5% or so, 13%. Yet I just showed you all those numbers. University of Michigan sentiment number, lowest ever. We have the fear and greed, CNN index, extreme fear, levels I've never seen before. The Goldman Sachs indicator, panic indicator, extreme panic. All of this stuff coming together, yet the market's still up. It doesn't make sense. There is a disconnect here. There's something going on, that there's a divergence that is very rarely seen. But the one pattern that I have seen over and over in my 20 plus years of doing this, when there's extreme fear, it's a great time to buy. When there's extreme greed, it's a great time not to buy. And we're at the former. We're at extreme fear. So again, we're putting out 5 new stocks today, and I'll talk about each one in a minute. But they range from US-based to Europe-based to from 6 billion to 140 billion, all over the gamut. And they've all, for the most part, pulled back with this market, creating what I believe to be great buying opportunities. This is always an interesting chart to look at. Is this a repeat of 2020 to 2000 bubble? I don't think so. I think it's completely different. And I have a lot of great numbers, but I don't want to take too much of your time today because I know it's a holiday week coming up. But you look at the numbers and the valuations of the NASDAQ back in 99, 2000, and you take it to now, they're not even comparable. NVIDIA, still the world's largest company, right? Trades with a PEG ratio, which is a PE right now, over its projected growth the next year or two. It's just over 1. Going back to 99, 2000, you were lucky, first of all, if they had a PE, because the E in PE stands for what? Earnings. Most of the companies didn't have any earnings, and we're never going to have earnings. Yet they're trading, up. I remember one of the first stocks I ever bought was a company called CMGI, and CMGI was a company that actually named Foxborough Stadium, whatever it's called now, the New England Patriots, who I loathe, but they named their stadium in I think 99 or 2000. Lasted only a year because the company ended up going belly up, or somebody bought them or something. But the stock basically went to nothing. But I remember buying that and thinking, this is the easiest thing I've ever done. I was a senior in college, so 99, or I guess senior in college, 99, 2000, and 20% a day, 30% a day. This is the easiest thing. What did I go to college for? Quickly learn it goes away like that. But these companies were not making money. NVIDIA, one of the most profitable companies ever. So this to me is not the same, but say, okay, it follows the same pattern. We still have a blow off top coming. We still have a lot big on the upside. If you think it's going to happen, we're not even close to the level right now of where you're going to see that blow off top. Very similar. This is NASDAQ after release. I've done this chart before in the past. After release, Netscape in December of 1994 and a release of ChatGPT at the end of November of 2022. And it shows a gain through 748 days. This was last week. You can see the gain's about similar. It's actually up more when Netscape did it. But look at the pattern. We take off, then kind of go sideways. We'll have pullbacks, and then that last little bit of movement there, last year or so. Again, so even if you think we're in a bubble, we're not. We're not at the blow off top yet. So even if you think we're in a bubble, you shouldn't be out of the market yet because we're not near that top, is what I'm trying to say. But we're not in a bubble right now. And is the Fed to the rescue? I think so. These odds of a rate cut at the December 10th meeting were huge. Take a look down here. It was 1 month ago, it was at 92% chance. 92% chance a month ago. Then it fell last week below 50. It was like, uh-oh. And that freaked the market out a lot because they've been pricing this in. It's back up to 83% as of this morning. So odds are Fed cuts again in December 25 basis points, and he probably cut a few times next year. That really is a nice tailwind for the market, folks. Great tailwind for the market. And I'll talk about two sectors that could get a tailwind in a second. Or is it earnings to the rescue, or both? You take a look at earnings. This is Q3, which we just kind of wrapped up the earnings reports. And you see the earnings growth year over year. You look at the Magnificent Seven, those big $7 trillion companies. I believe it's 11 now, but this is a Mag 7. If you take a look right here, as of today, 18.4% earnings growth year over year. That's fantastic for companies that size. However, people keep putting down the other 493. They were up almost 12%. That's some solid earnings growth. You figure the market's up about 13%. It's kind of right in the middle there. So it makes sense. Everything's being pushed with earnings this year. The PE ratio is not going through the roof. The PE ratio is actually the same on the S&P as it was the beginning of the year because earnings are keeping it there. We have earnings growth. And look at how they changed. This was just September 30th. The estimate for the other 493, 5.9, it came in at 11.9. So they're actually doing better than the estimates. So earnings in the Fed can continue to drive this market without a doubt. Oh, somebody's complaining. They can't see the numbers because my ugly mug is in the way. I apologize. I'll try to highlight them a little bit more. I apologize for that. Biotech breakout. So you're going to probably have a little bit on the right-hand side knocking this out. I want to talk about two sectors real quick before I get into the portfolio that we're talking about today. The biotech breakout's pretty amazing to me. Look at this. This goes back to November 2020. This is the IBB, the iShares Biotech ETF. The ratio of that to the S&P 500 over the last 5 years continued in this downtrend. And if my face is covering, I apologize. Just trust me. It broke this downtrend line a couple months ago. And to me, we are in the beginning of a long-term mega trend on the upside for biotech. And over on the left-hand side here, it's the biotech ETF again to the S&P 500 ratio. And this goes back much further. And you can see for years, look at that stretch of IBB outperforming, really from 05 to about 2014, about 9 years. And then from 2014 to 2025, about 11 years on the downside. We're due for a long-term outperformance. And man, oh man, there's so many ways to play biotech. I don't like the ETFs personally because there's too many in there. I think you have to do the homework, which I love doing when it comes to healthcare companies, looking for companies that have upcoming potential FDA approvals, have potential blockbuster drugs, drugs in areas that are going to need more treatments. Maybe they have no treatments yet as of yet. And a lot of these small mid caps will be bought up by the large pharmaceuticals because they don't have the pipelines at all. Their pipelines are dry as a bone for the most of them. So they're going to be buying up a lot of these smaller ones. And I got to tell you, this is an area I love. We've done very well on them this year so far. We've done really, really well on biotech for a lot of our different newsletters, and we'll continue to recommend them, not obviously in this AI infrastructure portfolio, but in the McCall letter, we're working on a brand new biotech portfolio as well. Before the end of the year, we'll put that out. Consumer pullback. This is kind of crazy as well. These are money managers. They cut the allocation to consumer discretionary stocks by the most on record. Look at this. That means if it's zero, it means they're flat. If it's negative, it means they're actually short the stocks. They're negative, and that's how much they are in consumer discretionary. And maybe that goes hand in hand with what I said. The University of Michigan Consumer Sentiment Index stinks right now. So, that is a problem. But I think there could be some opportunity there. Not yet, not recommending stocks as of yet, but even the consumer staples. Look at that. Percentage of overweight consumer staples, they're underweight as well. So you're looking at the staples. That's the Procter and Gambles of the world. Stuff you need, the staples, not discretionary. Consumers getting crushed. There will be a point, I don't know, maybe next 3 to 12 months that I think will probably have a great opportunity for some consumer stocks. Doesn't fit into innovation really, but when there's opportunity, that's when I like to pounce. So we're keeping an eye on both these. Biotech's already here. Consumer could be the next one. Now I got some good news before we jump into a portfolio. For everybody out there celebrating Turkey Day, and if you're not, put it in there because I don't know why you're not celebrating. Maybe you don't live in the United States. For those of you that are celebrating Turkey Day, even here in Nicaragua, we have a huge dinner, and it's always amazing. The real price of Thanksgiving meals, when you take a look, with CPI involved in 2025 dollars, the lowest going back on record. So that's a positive, right? I know we talk about inflation all the time, but based on $20 to $25, it's the cheapest it's been. And then if you look here, just kind of flat out, the Farm Bureau Thanksgiving meal for 10, see the price has come down quite a bit in the last couple of years. Still way up from where we were back in 86, obviously. But, when we take into consider inflation, we're actually, in real dollars down. So there's some good news before we head into the good news of the portfolio. So why the digital infrastructure portfolio? Why and why now? Why now? I just showed you because the market's giving us a great opportunity. And I'm going to pull up charts in a minute of different things, live charts of the S&P. And I will tell you, it's very rare you see something happen so quickly like we've seen here and create such an opportunity. But why specifically digital infrastructure portfolio? Well, Brookfield, which is a huge infrastructure company, a huge international, you've probably heard of them. They believe the growth of AI is going to require about $7 trillion of capital. Right, that's equivalent to about a quarter of the U.S. gross domestic product today. $7 trillion in capital. That's a lot of money sloshing around. They also believe $2 trillion that goes to AI factories, which that's infrastructure. $4 trillion going to actually the computing infrastructure. About $0.5 trillion going to power and transmission. All these are infrastructure related, which is really, really important. Why we're doing this. And Bain and Company, $2 trillion, they believe, in annual revenue is needed to fund computing power to meet the AI demand. And we're still about $800 billion short. So it's just showing we need to keep building, build. And we're going to continue to build. And it's not stopping anytime soon. This is a simple case of one factor being follow the money. And we're following the money. A couple of the stats just to throw in there. Global electricity demand expected to grow by 3% next year. You say to yourself, Matt, 3%, you're used to talk big numbers, 20%, 50%. Well, 3% is actually really good because electricity growth, especially in the U.S., has been stagnant at best for decades. So it's actually a big number. The other issue you have to remember is as demand increases, you have the supply, right? The problem with supply is the renewable energy is not coming on as quickly as thought. People were shutting down, countries were shutting down nuclear energy. Now they're trying to get them back up, shutting down fossil fuels, trying to kind of keep it longer without shutting them down. And then we have the issue with electrical grids, not just in the U.S., but around the darn world. They're terrible. I travel a lot. Power outages, all kinds of weird stuff happening. Gets too hot, shuts it off. So there's a big issue there. And how do you fix that? Infrastructure. Data centers are now responsible for about 3% of global greenhouse gas emissions. That's on par with aviation. Think about that. All the planes out there. So that's some people might say, I don't care. And I'm ambivalent, honestly. I obviously care. I love this planet we live on, but I don't base all my decisions off that. However, a lot of people do. So when you think about the infrastructure, the new infrastructure coming in to these data centers, they're looking for infrastructure that will help lower greenhouse emissions, which a lot of the companies in this portfolio will help them do. This just came out yesterday, both of these headlines. Amazon to invest up to $50 billion to boost AI supercomputing infrastructure for U.S. agencies. That's what the U.S. government. That was yesterday. Also, they came out earlier that morning yesterday. Amazon plans to invest $15 billion in northern India to build new data center campuses. They already have one there to build another one. So what we're seeing here, folks, is just the amount of money being thrown around. And there are people out there. Michael Burry, who's famous for the Big Short. And yeah, he was right. He's been pretty damn wrong. He called for the market top a while ago, and it's just keeps going straight up. And when he released, because he has a hedge fund, well, he shut it down, which tells me it probably wasn't doing too well. But when he released the last holdings, which they have to, super short some of the big tech companies. And yeah, they pulled back from the highs, but who knows when he got in those. I don't think those are doing too well for him. I don't know his entry price, but betting against it, boy, he's been wrong a lot. I don't want to be on his side right now. And go back to this real quick. The reason I said that was he believes all this money sloshing around is just not going out there, that there's accounting irregularities and they're boosting their bottom line. I'm not a forensic accountant, to be honest with you, but I'm not too worried about it because there's not too many people out there. And maybe he's ahead of the curve again. I doubt it this time. Digital infrastructure, again, why? So the rising share of U.S. power that's consumed by data centers, this goes from 2023 to 2030, more than doubling, though, in 5 years. 2025, this year, about 5%, going to 11.7 in 5 years from now. And by 2023, I should say 2030, sorry. By 2030, U.S. data centers will use 606 terawatts. That's 2 times what the UK used all of 2023, just for data centers. Granted, UK is not nearly the size of the US, but it just shows how much data they're pulling in, and they need to continue to increase this. This is a great chart. Data center versus office construction. Well, this is fascinating because, obviously general office, you can see construction of that going way down, but look at this surge, data center. So I guess I'm going to play devil's advocate here just because there's not a lot of questions coming in. People usually don't combat me in these things. But what if, the argument is, well, we missed it. They already built enough. Folks, we are in early stages. And as I said, we are getting to technology now that in the newer data centers and even older ones that need to be retrofitted to meet greenhouse emissions, to keep electricity prices down because they suck up so much electricity. They need to keep it so the cooling is done with water, not with blowing air like they used to. It's just too expensive. There's a lot of things that are changing. So we're in the very early stages of what data centers actually look like, which is important to remember. Again, office space continues to be empty as data center construction booms all around the country, all around the world, really. And this is a really cool infographic I got. And this goes back to an investment theme. If you follow me for a year or 20 years, one of my greatest or most successful, I should say, investment strategies over the last 2 decades has not been necessarily investing in that one company's leading, like the NVIDIA. Yeah, I did recommend NVIDIA a couple years ago, like $3, and it's up insane from there when I first recommended it. But at the same time, the picks and shovels are companies behind the scenes. And just to give you an idea what picks and shovels is, I think you know what this is. Picks and shovels are, think about the gold rush, right? You get out there. I told the story a million times. Go out, look for gold. The guys looking for gold, the women looking for gold, they didn't make it. Most of them lost everything. Who made money? Guys selling the picks and shovels. That's how Levi Jeans was created, selling Levi blue jeans. And the company's still around, 150 years later. But this just shows all the different areas of just a data center. This isn't talking about the grid or the cables or everything else, the transformers, the switch boxes out there, the switch gear, I mean. This is just in the data center, so many different areas. Now, let's talk about this. Here we go. Digital infrastructure portfolio. So there's going to be 5 stocks. The first stock, I have them written down over there. I don't know if you can see it, but is a $6 billion company. So mid cap, maybe you call it small cap, but more of a mid cap, but still a small company compared to an NVIDIA that's $4 trillion. So think about that. If this went up 10x in the next 5 years, let's say, I'm not saying it's going to or anything like that, but say it does, it's still a $60 trillion company, which is still not a large company by any means compared to some of the big ones. So these 2 stocks, stock 1 and 2, are both $6 billion, which it's a nice sweet spot for me. They build and operate high performance computing called HPC data centers. They build and operate these data centers. that are designed specifically for using AI, all the workloads. It's one of the fastest growing independent players, serving everyone not named big tech. So it serves a lot of the other companies. So it's a player that's kind of in the realm below these multi-trillion-dollar companies, which is great. I've got a couple questions here real quick before we go to the second one. Somebody asked why I closed my money management business. Well, I'll tell you this. It had to do with selling some companies and some things and moving things around. But I plan on opening it back up next year. So that's coming back. Build the money, build it. Yeah, you're right. People are they're late on building. So $6 billion market cap stock number 2. As the GPU clusters grow, the bottleneck's not longer and that's important because you have this data, but they need to talk to each other. So this company does that, which again, probably never heard of this company. You probably never heard of the first company either. Deep ties with NVIDIA. I like, when you have too many ties to one large company, that can be a risk, but not this one. From 2025 to 2028, it's expected to average over 50% growth in both the top line and bottom line. That means revenue and earnings per share. Huge growth expected for the company. All right. Next, stock number 3, $103 billion market cap. So it's getting a little bigger here. It's one of the largest energy providers in the world. And what I like about this, when I build these portfolios, I like to get different exposures to sizes, different exposures to all the little secondary trends within this big mega trend, as I showed you that infographic. And the larger ones give it some stability. And this has a dividend yield over 5%. This company is based in Europe. You buy it in the United States. It gives us global diversification, which is huge because you don't want to go all in on small caps, all in on large caps. You want to do this because we're basically building our own exchange traded fund. Our own ETF is what we're building here. And then stock number 4 is even bigger. We're at $61 billion market cap. It's got cables, connectors that are essential for the rack to rack in the server rooms, the server to server, the GPU to GPU communication. So again, talking to each other, cables and connectors. And this is a company I actually own personally. I own it right now, but it's a big company, so I can recommend it. It's $161 billion. I'm not moving it by any means, but I actually own this one. I've owned it for a while. This is a company that I didn't even realize was this big. When I bought it, it was not this big. But again, cables, connectors, and you probably never heard of it. A $161 billion company, you probably never heard. Actually, all 4 of these you probably never heard of. Somebody said you can't see the slides. Can anybody else see the slides? Hopefully you can. So the next one we're going to go to here is the stock that we're giving away today. It's not a fancy, exciting stock by any means. However, this is a company that I have in a select portfolio for 2025 that we had, which is now being in the market by nearly 3x this year. And you can see here, it's a big company. I guess let me reshare my screen here. Something happened. There we go. Can everybody see now? All right. I saw no slides. Can everybody see? Give me a quick yes, because it must have stopped at some point and stopped sharing. Can everybody see that? All right, cool. Sorry, folks. Well, let me go back then real quick. Stock 3, stock 4. I went through them, so I said it already. $103 billion company, one of the largest energy providers in the world, based in Europe, gives stability to the portfolio, gives us global diversification, and a dividend over 5%, which is nice. Stock 4, a little bit bigger, $161 billion. Cables and connectors. That's all you need to know. Within that data center, think about all the cables and connectors in that data center. It's amazing the amount that's in there. And again, this is a company I mentioned I own right now. So I just let the full disclosure out there with you. Or a McCall Letter member, become one today. And then there's the free stock, the Schneider Electric, SBGSY. So you can buy it just like you normally buy it, but it is a ADR, American Depository Receipt, which means that it's a French company, multinational, valued at $148 billion, but trades in the U.S. Buy it just like a normal stock. Put in your limit order and buy it. But they have so many different levels of that infographic I showed you. They have so many ties to so many areas within a data center. From uninterruptible power source, they call UPS, to switch gears, which are a major part of data centers, power distribution units, they call PDUs. They have cooling systems, which is, to me, a huge investment opportunity because, as I mentioned, the cooling systems pull so much electricity because they need to keep this stuff cool. Similar to cooling, let's say, a Bitcoin mining facility. A lot of electricity to cool that down. Same thing here, cooling systems, but they're on the next wave of cooling. And they bought a company in late 2024 to get into this area, and it's had great success so far. And they work with NVIDIA on the cooling these racks. They also make server racks. PE ratio is about 22.8. So that's average, let's say. But their earnings per share growth estimated next year at 20%. So that gives us a PEG ratio, PE over growth, about 1.14. That's extremely attractive. That's the type of value you want to see in a company like this. And I'll show you the chart in a second. It's got a small dividend yield, 1.1%, but it's paying out some money because it's been around a long time. And again, a big company, a big multinational based out of France. Now, two recent deals were announced, and just in the last couple of weeks. $1.9 billion partnership with a privately held firm called Switch. It's here in the U.S., and they'll be covering power modules and cooling systems, which is great. Those are two areas that we just talked about. And a $373 million deal with Digital Realty, which is a publicly traded company. DLR is their symbol. It's basically a REIT for data centers. So it's an interesting play, but involved in again, uninterruptible power supplies and switchgear. So they're supplying this for all types of big companies, small companies, private, public, you name it. You're seeing just quite a few deals being announced consistently in North America, which is great. Now, here's the chart. And what makes this attractive to me is you can see the stock hit a high. That was an all-time high and recently pulled back. Pulled back from 60 down to, let's call it 50. It's about 51. So that's about a 15% pullback. That's a great opportunity. A lot of stocks have pulled back, not just this one. And I read a great tweet recently, saying people loved Palantir at this price. They loved NVIDIA at this price. They loved Microsoft at this price. And it kept going on and on. And now a lot of these stocks have pulled back. They don't like them. The stock market is the only game in town where something goes on sale, people run the other way. We have Black Friday coming up, Cyber Monday. People are running to deals right now. The stock market happened to give us a Black Friday sale. We need to take advantage of it. All right. So speaking of Black Friday, special Black Friday offer. If you're not yet a member of McCall Letter, normally $298 a year. We're going to do something different. We're going to let you try out the first quarter. So you get 3 months for $19. I want to come up with a price where it's a no-brainer, like $19. I mean, think about it. If you take you and your significant other to Starbucks and grab 2 lattes and 2 egg sandwiches, you're spending more than that. Cut that for one day if you can't do it. But $19, you're really getting quite a bit, which I'm about to show you right now. You get all 5 stocks immediately. The moment this is over, they will be available. You sign up, you log in, they'll be there. Buy instructions, everything. You get weekly updates, both written and video. I do them video like this, but also do a transcript and write it out for people who don't want to watch video and rather read. We do the real-time buy and sell alerts. Anytime we buy or sell something, you get real-time alert. You can go right to your email. You can set it up to go right to your phone. We even have an app on the phone you can put in there that a little thing pops up and tells you anytime something comes out. It's fantastic. Access to all current and past portfolios. So all the stocks, the portfolios are out there now. We have electrification of everything portfolio. We have a deep sea mining portfolio that's been killing it. We have all portfolios out there right now. We have future innovation portfolio. We have a global exchanges portfolio that invests in stock exchanges around the world. All access to all those immediately. All past special reports, all available to you as soon as you log in. Any new special reports that come out, I'm going to do a special report on this portfolio over the weekend. I'll get it out next week, but I wanted to get the stocks out prior because I thought it was that important. But all new reports that come out while you're a member, and then quarterly live calls with me. And I think we're going to start doing those monthly. We'll sit down every month, do something like this. You can come in, ask me questions about the portfolio, and then we can actually look at the stocks in our portfolio, which is really cool because we get to actually look at them at the same time. So that's where we are. Again, any comments, questions, please let us know right now. I'm going to take any comments and questions. I'm going to pull up a couple of charts for you as well as the questions come in. Any stock questions, any market questions, any questions on the product, whatever you have. But again, $19. I wanted to, this is pretty rare in this industry. Usually maybe get down to 49 or something, but I want to give people, look behind the scenes for $19 for the first quarter. You're looking at what, $6.50, 60 cents or something a month. You can't really go wrong. So anybody have any comments, questions, please let us know. Somebody asked, what about the other four symbols? Well, if you're a McCall Letter member already, you have them. I'm going to put them out as soon as they come out. If you're not yet, you could join, as I just mentioned, for everything I just talked about for $19. So I highly recommend it, because we are in a market right now, folks, that if you don't have some guidance somewhere, you're going to make bad decisions. It's just how it is. There's too much noise in the market. The media is not there for you. The media is there for clicks and for views. So you really do have to do this. So question came in from Nick. Does the basket approach really work? Because it didn't work through the last downturn. Yeah, the basket approach does work. It has worked for me. So not every basket that I've ever put out over the last 20 plus years of doing newsletters has worked. It hasn't. If I was that great, I probably wouldn't be sitting here talking to you, to be honest with you. But it absolutely does work. It does keep you away from getting stock specific to one stock. It's too risky to try and pick one stock, in my opinion. There's way too much risk. Sure, there's more upside, but if you do it right, you're actually lowering risk, but not lowering the reward potential the same. So reward to risk ratio actually increases, in my opinion, by doing the basket. As long as you're able to get a diversified portfolio, I think you're really setting up for the only way to invest, in my opinion. Because you said you want to have exposure to the infrastructure that's building the future of AI. All right. You say, well, I'm just going to go buy Schneider. That's way too risky. You're putting all your eggs in one basket. Say I'm going to put 5,000 in Schneider in this trend. I'd rather you put 1,000 in 5 different stocks. I don't think you lower your upside potential by much at all, and you lower your risk dramatically. And it's you have to think here, when you're making these decisions, you're managing your own portfolio. You're a DIY. You're doing it yourself if you're doing this, and you need to realize that you can't take too much risk. Sure, you'd say, why would I bought that one, or what went up 10x? What if you bought the one that went down 80%? If you have one that goes down 80% and the other 4 stocks do well, you're covered. It doesn't matter. Way too much risk, in my opinion, to pick just one stock. So any questions here, please put them in there. I'm going to switch over here, though, real quick, and I'm going to pull up some charts for you, because I'm going to show you a couple of charts. So here we go. Here is the S&P 500. And we closed today at a really nice close, right near the highs of the session, up nearly 1%. We were down earlier this morning. As I mentioned, we're down less than 2%. And if you're already a member of the McCall Letter or any of my other newsletters, I drew this line about 2 months ago. And I said, this is a very important line on the SPY, the S&P 500 ETF, which is at 654 is where that line's at. This was a high that we broke through. We tested it. We tested it. We tested it. We made a new high. Came back and almost broke it again, and then rallied. And we tested it all through last week and rallied again. Very important short-term support. And I've been saying, I wouldn't be too surprised if it breaks that and comes down to the 200-day moving average, which also has some price support down here around, let's call it 614, 615. Could still pull back there. I don't know, folks. That would be a really strong longer-term support level. But short-term, we're holding it. And that just tells me how strong this market is right now. It is truly holding up in this market. And then let me show you Schneider Electric here. Had a decent day today, up 1.2%. But again, let me show you a longer-term chart. And this is important. There are times where it kind of consolidating, pull back a little bit. But a lot of these pullbacks, this was Liberation Day, obviously, with the big pullback. But most of these pullbacks have bounced back really nicely. And this is just a great uptrend over the last about decade or so. Took off about 8 years ago. Looks really good on a longer-term basis. And short-term basis, again, sitting on nice support. This blue line's a 200-day moving average, sitting on that as well. And then you have the RSI here, which just today crossed from below 30 to above to neutral zone. And that's what's called an RSI buy signal. Just happened today. And that typically is a very, very good sign. You see it did it here. We rallied short term and took off longer term. We did it here after Liberation Day. You saw what happened there. That's the only times we've really done it over the last year. So it's pretty rare. When it does happen, though, it does perform well. It performs well for a lot of charts. The S&P, it performs very well also. So to me, Schneider Electric is a really great opportunity right here. Um, so yeah, again, folks, I mean, for $19 for a quarter, try it out. I think you're going to get a lot of great education out of it. You're going to have a lot of more fun because you're going to be interested in the market a little bit more. And then ultimately, obviously, our goal is to help you make money and beat the market. That's what we're here for. That's what I work every day behind the scenes, going through charts, reading articles, reading books, talking to people, traveling to conferences, you name it, trying to find really where that next opportunity is. So again, any comments, questions, let me know. Any stocks you want me to look at, I can do that now. But if not, I guess we can wrap it here if nobody else has any more questions. And really, I want everybody to know I want them to have a great holiday. And spend time with your family, friends, whatever it might be, alone, whatever you prefer to do. Don't eat too much turkey, but have fun, watch football, enjoy what life's about, and maybe turn off the media for a little bit and get away from negativity, because life's not nearly as bad as all those extreme numbers I showed you to begin with. Or just life's not that bad. Be grateful for what we have. I live in a third world country, so I see poverty on a firsthand basis out my window right down the beach. And we need to be grateful that we have the potential to invest in these stocks and move forward. But again, for $19, I'd love to have you join, if you're not yet a member, to jump in and join us here and get in there. The link's on the right-hand side. We'd love to see you. So again, thank you so much, everybody who are already members. Thank you for all the new members. And for those of you that tuned in to watch, I thank you very much as well. Have a great holiday. We'll see you again soon. For everybody here at Next Wave Research, I'm Matt McCall. Have a great holiday.